In a striking shift in global energy flows, China's imports of U.S. crude oil have dropped nearly 50%, reflecting both the country's evolving energy priorities and the broader reshaping of world oil markets. According to recent data from KPL, China imported just 81.9 million barrels of U.S. crude in 2024, down from 115.6 million the previous year, marking a 46% decline. As a result, China has fallen from being the second largest importer of American oil to the sixth largest. This shift has significant implications for global oil markets. Key drivers behind the decline. Several factors are driving this dramatic drop in U.S. crude imports. First, China's overall crude imports have decreased by approximately 7.2% year-on-year, a decline partly attributed to intermittent COVID-19 lockdowns, high domestic inventories, and scheduled refinery maintenance. However, China has adjusted its procurement strategy, seeking more competitive or flexible terms. Official customs data suggests a shift away from Western suppliers as part of Beijing's broader approach to securing cost-effective oil, while reinforcing its energy security. The rise of discounted crude. Recent data from Clair shows that China has increasingly sourced crude from Russia, Iran, and Venezuela, with the share of seaborne crude from these nations rising from 24% to about 26%. Though this percentage increase may seem modest, it represents a substantial volume of oil given China's vast import base, which can exceed 10 million barrels per day. Russia, offering steep discounts on its Urals crude due to Western sanctions, has become particularly attractive to Chinese refiners seeking lower feedstock costs. Similarly, Iran, under U.S. sanctions, continues to ship crude to China through covert methods, including disabling transponders and conducting ship-to-ship transfers near Malaysia and the Persian Gulf. Venezuela, too, affected by U.S. sanctions, often uses complex payment terms and intermediaries to ship oil. But its discounted prices remain appealing to China's cost-sensitive refiners. The strategic shift, this shift toward discounted supplies, has not only filled the gap left by reduced Western imports, but also deepened China's relationships with politically isolated oil exporters. The realignment is driven by a combination of economic and geopolitical factors. Economically, Chinese refiners benefit from purchasing crude at prices below global benchmarks, allowing them to either subsidize domestic fuel costs or boost exports of refined products, especially to other Asian markets. Geopolitically, diversifying suppliers enhances China's energy security by reducing dependence on any single producer or region, thus minimizing vulnerability to geopolitical disruptions. Moreover, by increasing ties with countries like Russia, Iran, and Venezuela, China bolsters its position in the global arena as a major energy consumer willing to engage outside the U.S.-led sphere. Tracking and trade dynamics. The flow of sanctioned crude to China is often opaque, with satellite imagery, automatic identification system data, and port filings revealing complex shipping techniques. These include turning off transponders and conducting ship-to-ship transfers, particularly in Malaysian waters, to obscure the true origin of cargoes. As a result, official Chinese customs data may not fully reflect the volume of Iranian or Venezuelan oil, as some shipments are mislabeled as originating from Malaysia or Oman. Despite this, the increase in these imports suggests a clear strategy to exploit pricing differentials. A 2 percentage point change in import origin may sound small, but considering China's massive energy needs, it indicates billions of dollars in redirected trade and a reshuffling of global shipping lanes. Global implications. China's evolving oil import patterns have far-reaching consequences for global energy dynamics. The rising share of discounted crude from sanctioned countries raises questions about the effectiveness of Western sanctions and exposes loopholes that allow oil to continue flowing. By selectively purchasing cheaper oil, China can influence global benchmarks and market sentiment. This trend may also pressure traditional suppliers like Saudi Arabia, Angola, and Brazil, prompting them to adjust official selling prices to maintain market share. For Russia, a key member of the OPEC+ alliance, discounted sales to China could undermine efforts by other OPEC members to maintain higher price levels. On the geopolitical front, growing ties between China and sanctioned oil exporters may alter international alliances, positioning China as a key global player engaging with countries outside the Western economic order. In summary, this shift not only helps China secure more affordable energy, but also strengthens its global influence, reinforcing its position as a leading energy consumer navigating a rapidly changing world oil market, strengthening Beijing's global leverage. As Beijing continues to advance its economic and geopolitical strategies, it is strengthening its influence not only within its own region but on the global stage. This shift is expected to have far-reaching consequences in international trade, diplomacy, and energy markets. By leveraging its growing economic power, China is positioning itself to set the stage for significant changes, particularly in energy consumption and global relations. As China's role in these markets grows, its influence on energy policies, trade agreements, and diplomatic initiatives is likely to intensify, altering the global landscape in fundamental ways. The rise of electric vehicles and renewables. One of the most significant developments in China's economic strategy is its rapid adoption of electric vehicles, EVs, and renewable energy. In recent years, China has made incredible strides in EV production, with the country now leading the global market in terms of both manufacturing and adoption. This shift directly impacts global oil demand, as more and more Chinese consumers turn to EVs. The country's government has been actively pushing for electrification in both transportation and industry, creating a substantial market for clean energy technologies. This transition to electric vehicles will likely lead to a long-term decrease in China's oil import needs, diminishing the country's reliance on crude oil as the backbone of its energy consumption. As the demand for oil decreases, China is shifting its focus toward alternatives, including cleaner energy sources such as liquefied natural gas, LNG. The growing availability of LNG, along with the country's heavy investments in renewables like solar and wind power, further reduces China's dependence on traditional, crude-based energy. This energy shift gives China significant geopolitical and pricing advantages, positioning it as a key player in the transition to cleaner energy sources. These developments could have lasting implications for both global energy markets and international relations, as China's approach to energy diversification continues to evolve. China's strategic economic alignment with Russia and Iran. Another critical element of China's growing global influence is its strategic economic alignment with Russia and Iran. Over the past decade, particularly after the annexation of Crimea in 2014 and the subsequent imposition of Western sanctions, Russia has significantly pivoted toward China, especially in the energy sector. With Western sanctions hampering Russia's access to international markets, China has emerged as an increasingly important trading partner. This collaboration has intensified following Russia's 2022 invasion of Ukraine, which led to even stricter sanctions from the West. In response to these sanctions, Russia has begun offering its energy exports, particularly crude oil, to China at discounted prices, creating an advantageous situation for Beijing. By 2023, bilateral trade between China and Russia reached an all-time high of $240 billion, with energy exports comprising a large portion of this exchange. Among the most significant milestones in this growing partnership is the completion of the Power of Siberia gas pipeline in 2024, which has significantly improved China's access to Russian natural gas, further cementing the economic and strategic ties between the two nations. Similarly, China's relationship with Iran has been shaped by the ongoing economic sanctions imposed by the United States. Despite these sanctions, which are aimed at curbing Iran's oil exports and limiting the country's financial resources, China has continued to import oil from Iran, often at discounted rates. This arrangement benefits both countries. China secures affordable energy resources, while Iran maintains a crucial economic lifeline amid its ongoing isolation from the global financial system. The impact of U.S. sanctions on Iran's energy sector. In October 2024, the U.S. imposed new sanctions targeting Iran's petrochemical and oil industries, aiming to diminish Iran's financial ability to fund its missile programs and other activities deemed destabilizing by the West. These sanctions are part of a broader strategy to pressure Iran into changing its behavior and halting its nuclear ambitions. However, despite these efforts, China has continued to play a critical role in supporting Iran's energy sector, ensuring that Tehran has a steady flow of revenue from its oil exports. This arrangement further complicates the U.S.'s efforts to isolate Iran, highlighting the geopolitical complexity that arises from China's strategic partnerships. Implications for U.S.-China energy trade. China's strengthening energy ties with Russia and Iran also have important implications for its trade relationship with the United States. As China secures discounted oil and natural gas from these sanctioned nations, it is presented with a competitive advantage in the global energy market. This shift could reduce China's reliance on U.S. energy imports, especially in the context of ongoing geopolitical tensions. By diversifying its energy sources and relying less on traditional Western suppliers, China is positioning itself to weather potential economic or diplomatic conflicts with the U.S. more effectively. Geopolitical considerations are central to this shift in energy trade. As China seeks to diversify its energy sources and reduce its exposure to Western political pressures, It is making calculated moves to align itself with countries that have long been at odds with the U.S. This approach not only strengthens China's energy security, but also enhances its ability to influence global energy markets and reshape the geopolitical order in its favor. Broader geopolitical and economic strategies. China's engagement with Russia and Iran extends far beyond energy trade. It is also part of a broader strategy aimed at counterbalancing Western influence and increasing China's strategic autonomy on the global stage. By deepening ties with these nations, China is positioning itself as a counterweight to the U.S. and its allies, further undermining the dominance of Western powers in global politics. This approach is not just about securing energy resources, but also about reinforcing China's role as a major player in shaping global economic and political systems. This strategy aligns with China's Belt and Road Initiative, BRI, a global development strategy that aims to expand China's economic and political influence through infrastructure projects and trade partnerships. The BRI is a key element of China's broader geopolitical vision, and its partnerships with countries like Russia and Iran are central to the initiative's success. By leveraging its energy relationships with these nations, China is not only securing essential resources, but also increasing its influence in regions that have traditionally been aligned with Western powers. Conclusion: as China continues to solidify its energy relationships with Russia, Iran, and other nations, it is creating a new, multipolar world order, in which its influence is more pronounced and its ability to dictate the terms of trade is stronger. The nation's growing dominance in the electric vehicle market and the expansion of its renewable energy resources further enhance its position in the global energy market. These changes are not only shaping China's future but also altering the dynamics of global trade, diplomacy, and geopolitical power. By deepening its economic ties with key strategic partners, China is ensuring that it remains at the center of the global energy transition and the broader international political landscape. Impact of reduced exports to China on the U.S. economy. The decline in oil exports to China could lead to an oversupply in the U.S. market, which may put downward pressure on domestic oil prices. This scenario could harm U.S. oil producers, potentially reducing revenues and leading to decreased investment and job losses within the sector. Additionally, a sustained drop in exports could widen the U.S. trade deficit, influencing broader economic indicators. This shift in trade dynamics is largely driven by geopolitical tensions and evolving trade policies. The U.S.-China trade war, marked by tariffs and trade barriers, has pushed China to diversify its energy imports, lessening its reliance on U.S. oil. This realignment highlights the complex relationship between economic policies and international relations. China's journey as a major oil importer reflects its rapid economic transformation and growing global influence. From being a net oil exporter in the early 1980s, China has become the world's largest importer of crude oil. This transition underscores the interconnectedness of industrialization, energy security, and geopolitics. The shift began in the early 1990s when China moved from being a net oil exporter to a net importer in 1993. This change was fueled by rapid economic reforms and industrialization under Deng Xiaoping, which significantly increased domestic energy consumption. China's domestic oil production could not keep up with the growing demand, so it turned to nearby regions like Southeast Asia for imports. By the early 2000s, China's energy demand surged, spurred by its entry into the World Trade Organization, WTO, in 2001 and its subsequent economic boom driven by manufacturing and infrastructure development. Oil imports steadily increased, reaching over 4 million barrels per day by the end of the decade. This period also saw the development of key infrastructure, such as pipelines and refineries, to manage even higher import volumes. The 2010s marked an era of unprecedented growth in China's oil imports. By 2017, China had overtaken the United States as the world's largest crude oil importer, a milestone reflecting both industrial demand and a growing consumer base. During this time, China began diversifying its oil imports, reducing its dependence on Middle Eastern oil by increasing imports from Russia and Africa. By the end of the decade, China's imports had reached about 10 million barrels per day, cementing its central role in global energy markets. Despite the global disruptions caused by the COVID-19 pandemic, China's oil imports remained strong, averaging about 11 million barrels per day. Strategic stockpiling played a key role during this period, as China took advantage of plummeting oil prices to fill its reserves and ensure long-term energy security. In the following years, imports fluctuated due to shifts in domestic demand and the ongoing effects of the pandemic. Yet imports reached a record 11.3 million barrels per day in 2023, fueled by a robust post-pandemic recovery. China's decision to reduce or eliminate oil imports from the United States while deepening energy ties with BRICS nations, particularly Russia and Iran, marks a significant shift in its energy and geopolitical strategy. This move highlights China's pursuit of energy security through diversification, cost reduction, and stronger alignment with strategic allies within the BRICS framework. However, this realignment has significant implications for the United States, both economically and geopolitically. China's pivot away from U.S. oil imports aligns with BRICS's broader goals of establishing a more multipolar economic and political world order. The West's sanctions on Russia, following the Ukraine conflict, have given China the opportunity to access discounted Russian crude, further incentivizing this shift. Meanwhile, China's increasing energy imports from Iran provide further diversification across different continents, reducing its exposure to disruptions tied to U.S. trade policies or geopolitical tensions, and reinforcing its energy independence. From an economic perspective, discounted oil from Russia and other BRICS countries allows China to meet its energy needs at a lower cost. Additionally, these relationships allow China to bypass the U.S.-dominated global oil trade system, potentially using alternative currencies like the Chinese yuan for transactions. This undermines the U.S. dollar's dominance, which has long been a cornerstone of U.S. economic power. The decline in U.S. oil exports to China could disrupt the U.S. energy sector. China has historically been a major market for U.S. crude oil, and its reduced demand could lead to oversupply in domestic markets, potentially driving down oil prices. This would squeeze profit margins for U.S. producers, limit investments, and may even lead to job losses in energy-dependent regions. Additionally, related industries such as logistics and refining could experience slowdowns. Geopolitically, China's shift reduces U.S. influence in the global energy market. By strengthening ties with BRICS countries, China is helping to build a parallel economic framework that challenges U.S.-led systems. This shift is particularly significant as BRICS nations pursue alternative financial systems and seek to reduce their reliance on the U.S. dollar. The reduction in U.S. oil exports to China weakens a key tool of U.S. economic diplomacy. Furthermore, the loss of Chinese demand could exacerbate existing trade imbalances, particularly as energy trade has been one of the few positive aspects of economic engagement between the two nations. With the growing adversarial tone in U.S.-China relations, mitigating the economic fallout from this policy shift becomes even more complex.